Well, good morning, everybody. Thank you for joining us for another edition of our weekly real estate backstory. We kind of pull back the covers of the real estate industry and expose its soft underbelly. That being said, we do this every Monday, and we appreciate you guys kind of joining us. We got a lot of really interesting things that we want to share with you guys. And so probably the first one that we really want to share here is going to be fair housing. So NAR has National Association of Realtors has
introduce your name. That's okay.
Oh, okay. Hi, my name is Alan Richardson. I'm managing broker at Maximum Realty Realtor Partners.
Hi, my name's Bing Richardson. I'm the compliance broker for Maximum One Realty and Realtor Partners.
And we'll start this all over again.
There we go.
All right.
Happy Monday.
National Association of Realtors has mandated fair housing training for all members. And so this is a new change. Now we've got several years. It doesn't begin until 2025. So we've got a couple of years to prepare for it. And already, and it's going to work in conjunction with our normal 3-year cycle. Every 3 years, we're required to have 3 hours of code ethics training. Now, in addition to that, we're also going to be required to carry 2 hours of fair housing training. Now, we don't know what that looks like quite yet. For us, we teach the code of ethics training already, and we will, if we're able, we're going to try and teach the fair housing training, but no one knows what it is yet. And
I didn't know that federal HUD was awarded $48 million for fair housing education, along with Hester out there. So be aware that there's going to be more things coming online.
Yeah, but this doesn't have anything to do with HUD. This is all for realtor.
Fair housing is education.
Yeah, well, that's very true. But we're just trying to kind of give you guys a heads up. And so, like this is one of those things that I feel is very important that we do need to understand. Of course, the same thing with our code of ethics. Code of ethics is incredibly important, but also fair housing and making sure that, because I find that a lot of times it's where the realtors mess up and accidentally violate fair housing.
It's indirectly. It more is a I guess when you're geographically raised a certain way and you don't think about certain thing you say, and it does affect other people.
Our property description, sometimes we describe people and not places.
Well, like the master bedroom is now called primary bedroom versus master. So
things like that. I think that was silly.
It is silly because it's been called master bedroom for the longest time.
But where I see more is where people like great for families,
or family needs to be taken out.
Yeah, and great for anybody kind of thing would be the right thing to do. All right, we want to jump, change gears and start talking about all things mortgages, because there is a lot of information about mortgage. And so first thing is that the CPI and inflation are trending down. And so the good news for us is that the 10-year treasuries and interest rates really follow inflation. And so as inflation mitigates, we are seeing the same thing happening with interest rates.
CPI being consumer price index and PPI being producer price index.
Yeah, what is costing the goods for the manufacturers to get.
Correct.
So, even though the Fed raised the federal funds rate last week, we saw interest rates continue to drop. And at the same time, mortgage demand has spiked up. Even though the Fed raised rates, mortgage rates came down and demand went up. And so that's a really good thing for us.
As you can see, the spike is due to decrease of the interest rate. Not necessarily what the federal government is doing.
Yeah, they're related, but not exactly.
Correct.
Now, at the same time, a new study came out and said that U.S. borrowers purchased 15% more mortgage points last year than they did the year before, and I know that we don't, in the real estate world, we don't deal directly with the mortgages, but we have to have a good, solid understanding of mortgages. We have to understand what buying points down really means. And when we have about 45% of conventional borrowers are buying points down, when half of your borrowers are buying points down, and then I've had agents who are like, I don't understand what buying points down are. I don't understand how this works. And so we need to really, so, you know, like the mortgage 101 classes, the FHA classes, all the classes that our lenders are putting out there. Please take some time
and learn it
to do that, because we're seeing more 2-1 buy downs. We're seeing some 3-2-1 buy downs.
And I've seen some permanent buy down, which costs a lot more, but in the long run, it'll save the home buyer a lot more money.
Yeah. I'm not a big fan of the permanent buy downs right now, you know, just because I feel that mortgage rates are moving in the right direction.
Well,
So-
and that, you know, the most of our are betting on the interest rate going to come down again versus going up to what the current interest rate is.
Yeah.
So,
all right. Next thing that we want to kind of talk about mortgage related is that FHFA rescinded the DTI loan level pricing adjustments. Like, and the great thing is I just spent like 15 minutes in our sales meeting last week explaining how the loan level price adjustments are. And so, you know, what a loan level price adjustment, this happened ever since 2006. And it was there to just kind of stabilize the entire mortgage industry and kind of have a level playing field for everybody. And so they went through and they made some adjustments. Now they issued those adjustments in January, and then most of the lenders tried to start, you know, putting them in place
because it wasn't effective until May. It wasn't really a topic that was being talked about until very recently.
But it caught a lot of news because when you look at it, you know, a good borrower is not paying with high credit is not paying more, but their discount rate was not as good as it used to be.
Correct.
And so there was a lot of feeling in the industry and with just some borrowers that like were
being penalized,
you know, financing the rich to penalize or to benefit the poor. And you know, at the same time, they went in and they made these debt to income ratios as well as the down payment ratios, and that made this so difficult for the lenders. And so, you know, before May 1st, like right before, like the day before May 1st, they went out and they said, you know what, we're going to hold this off until I think September. And so we're going to, you know,
so we'll probably have
we're going to pause it.
Talk about.
Well, no, not really, because you know, first they paused it until September, and then they said, well, the problem is that all the lenders are already pricing in these new changes, and then they came back and said, you know what, and well, what they really looked at was all the industry professionals, the lending companies, the mortgage companies. They went back and said, listen, we can't do these down payment amounts the way you're asking us to, because it was like, if you're putting this 20% down, it's going to be this rate, and if you're putting down 15%, it's this rate. And when we pre-approve our lenders, I mean, I'm sorry, when we pre-approve our borrowers, we don't exactly know what the down payment is, and we're pricing loans incorrectly. And then you guys are going to penalize us for having this wrong. And so you're putting the cart before the horse.
All right.
And so, you know, just with all the controversy, with the way that the consumer was feeling about the price adjustments, and the fact that the industry was having a conniption fit, not so much about the rates, but much more about the way that they were trying to implement it, they said, you know what, let's hold off. We're just not going to do anything at all. And so they went in and just basically pulled the plug on the old thing, said, all right, everybody back to the old way.
Yep.
And so that's where we're at. So, you know, we've been through several months and a lot of controversy for nothing, basically. All right. Now, at the same time, you know, one thing that we see a lot in the news right now is, and I'm not trying to get political, but, you know, the U.S., will the U.S. default on its debt? And the challenge here is that I don't think it's going to happen, and I don't want it to happen, but we have to understand that real estate will feel the effects of that happening. They said if the U.S. defaults on their debt, mortgage rates will jump to 8.4 immediately, because now all U.S. debt is now seen as a riskier proposition that's going to hurt across the board on all of our markets. And so lending costs will go up 22% the first day that happens. And so this is, and again, I'm not trying to be Mr. Super political, but like, this is not a good move. Okay. And like right now, housing is really poised and positioned to really pull the rest of the economy out of any pseudo or mini recession kind of thing that I feel that we might be heading towards. But if we default on our debt, we are basically just like shooting ourselves in the foot. So not trying to be political, just trying to say, listen, it really is, it has consequences for us in the real estate world. And at the same time, housing sentiment is shooting up. Now you can see that it's been higher back in 2017, 18, that kind of stuff. But we're running several months now of housing sentiment continuing to improve. And a lot of that is based on mortgage rates. Seeing mortgage rates come down, that really means that we're seeing a lot more optimism from our borrowers and buyers in the market. At the same time, MBS Highway, huge lending institution kind of thing, they poll realtors and they said, they basically say, do you see home prices accelerating, increasing, or decreasing? Well, the number who see it decreasing is really down, and then one number who sees it increasing is really up. So we're seeing property values increase exponentially. I mean, and the realtors are the one who are saying that.
We're the one in the industry, so we know the numbers. So therefore, the old adage, let's wait and buy our home, it's going to cost you more every year that you wait and buying a property.
Yeah. Now, NAR just released the areas with the largest percent gain in single family, and like Warner Robins down south of us, near the military base. They're the big representative for Georgia. They're number 3 in the nation on the largest property value gains. But at the same time, I don't know if you've seen this, but there's a news there's this thing that's being circulated around. It looks like 2 newscasters doing it kind of thing. And really, that's not what it is. And they've been sharing a graphic from Florida Atlantic University College of Business, in where they go in and they rate the 100 top U.S. housing markets. And in their rating, they list Atlanta as the number 1 overvalued or with the highest amount of premium discount in the nation. And our challenge is that that's not what we see in reality. And so, I had to kind of dig into this, because I had several people send this to us over the past week and be like, well, you've been talking one thing, but this chart looks really crazy.
Yeah.
Right. And so, I went there and started looking at it. And so this is how they kind of rank us. And what they did is they went in and they pulled Zillow data. And then they also went and said, you know what? And now it is true that property values have appreciated for 4.4% for the last 50 plus years kind of thing. Well, they went in, they just kind of drew a baseline and said, you know what, property values should accelerate this much. And then
but you can see where a chart Atlanta's have value. It shot up quite a bit.
And we're only at like 3 or 4% property value increase, which is very healthy for us. That's where we need to be. Our market shot up just like a lot of other markets, and you can see that moves. But when you look at the listing and the ranking of the metros that have the highest, what they call premium discount, you'll see that none of those markets are challenged markets. Ours is the same way. And so, they just chose to pull up Zillow data and say, you know what, property value should appreciate this amount they dictated what rate of return it should be.
Correct.
Versus where it is, and said that's how much you're overvalued. That doesn't have any bearing on what's really going on in the market.
Absolutely.
Now, we also went and pulled up, CoreLogic, and they are the data source for like all the MLSs in the United States. And said, what are the markets where that has the largest moves in values? And you see Miami's up big, Boston's up, Washington's up, Houston's up, but over the West Coast, San Diego, LA, Las Vegas, those are down 2 and 3%, that kind of stuff. And so if you look at like where Georgia falls in, we're in that 4 to 7%. We're running right about 5% property value increase right now, and we're in a really solid place. So I'm trying to make sure that we have the information that we need to really be able to offset it, because anytime there's some sort of negative news or somebody pulls some kind of number out of their derriere, I'm sorry, it's frustrating for me, and it hurts our
doctrine of all data. When you have CoreLogic actually takes the real actual factual numbers, there's it's like reality and concepts.
So And actually, if you look at CoreLogic actually releases the top markets at risk of home price declines, and guess what?
We're not at.
And none of those happen to be on the list that college down in South Florida listed. Like there's no basis on like reality for that side of things. So
and that's what you gotta be careful when you hear on medias and different folks that use the college, the business as a source of publication. Understand where they get their data from, because that makes a difference.
Well, also sometimes they take just a really small snapshot. Like recently we've had a lot of people talking to us about foreclosures, and they say, foreclosures, if you just look at foreclosures for the last 2.5 years, you'd be like, wow, foreclosures are really shooting up. But when you look at it over the last 20 years, you can see that our foreclosure rate's somewhere around 500,000 homes a year, and we're around 250,000 homes a year. So we're about half of what would be considered a good time in foreclosures. So,
and that's that is throughout US, so it's not just indicative of just Georgia.
And so for us, we're seeing activity increase. Like this is from our own brokerage here, kind of thing. And you can see that in March for our 77 listings, we had 9,200 views, versus for less listings, we have almost 11,000 views. So, the activity level is increasing. We're seeing a lot of positive things happen there. At the same time, we're also seeing where, where are people searching for homes? Well, the number one that's coming from outside of our metro is going to be
New York, New Jersey, and Jersey City.
New York, New Jersey, Pennsylvania. That's the number one. A third of all property viewings in Atlanta come from New York, New Jersey, and Pennsylvania. So if you're looking to try and partner with realtors there and do referrals, that's a smart place to be and really looking at, because we're looking at real data now. And some of this data, like this is our this is national data here as well. So you see our total listings right now are down. I mean, yes, they're up over last year. But when you look at our total listings compared with
pre-pandemic,
any year that we have in there, and I mean, just look at our active national inventory. Yes, nationwide inventory is up 48% over the last year. However, we're down 50%
on the last 4 years.
Yeah, I mean, and we got more people. We've been making babies, but we ain't got enough houses, and that's kind of one of our big challenges there. So overall, pending listings are down, and down pretty significantly, but not down as much as they have been. So down about 22%. We're down about 16% here in Georgia. Those are, but if you look at our pending listings compared to where they were 2017, 2018, you think, man, things are pretty good, right? Because it's kind of been going crazy for the last couple of years. Now, new listings are down. We're continuing to see new listings are down over 20%. And same thing here in Georgia. We don't have enough listings, and our new listings are coming. We don't have enough new listings coming in the market. So that's part of the reason why pricing is continuing to grow faster than we really want it to.
There's not enough inventory.
Yep. So overall, median listing price is up about 2.5% nationwide. We're still running about 4 or 5% here in the Georgia area. And so you can see that for the month, according to NAR, the median list price was up 2.4% for Atlanta as well. So we're still in positive property value appreciation range, that kind of thing. Now, that's for overall all the markets, that kind of thing. What's going on with our investors? Well, investors have been having a little bit of a harder time. And so investors lost money on 14% of the homes they sold in March. It's pretty much the highest share since 2016, but it's not kind of across the board. You have your big time investors that are really swaying these numbers. And so I just wanted to, and I'm not pointing this out to be like, yay, they're having a hard time. I'm pointing this out because you need to know what's going on in the market. And also, is there also some opportunities for some decent deals here? And so first one, Open Door lost $100 million in the first quarter. And so that works out, they sold about 8,200 homes. They lost $12,000 for every home that they sold for the first quarter. So, and the crazy part is that's an improvement over where they've been.
Right.
If I said, you know what, honey, our business, I'm hoping to only lose $100 million this quarter. I don't think that would really gonna fly. Yeah. Yep. Now, and then OfferPad came in, and OfferPad only lost $60 million for the first quarter. And it cost them $37,000 for every home they sold, because they lost $60 million on, like, I forget what the number is here. But on quite a few hundred as well, like 2,000 homes. And so they lost about $37,000. So again, I'm not trying to revel in anyone's misfortunes, but by the same token, is their investors are having a hard time. A lot of those big losses are being felt by these really big companies. A lot of our smaller investors are not faring that poorly. We know a lot of investors that are actually doing very well. But if you just read the headlines, you would think that it was bad for all investors. So don't think that our local investors, things like that, are really struggling, because I know a lot of investors that are rocking it right now. And also at the same time, we've had some of our agents that have been getting some pretty decent deals on OfferPad and Open Door Properties. So
just awful.
Yeah, so that's good for our buyers. Now, rent growth has slowed again for our 11th straight month, and
which is good, because honestly, during pandemic time, they were really high.
Well, and there's two schools of thought here. One is, well, if rents are coming down, then people would rather rent than buy. And I disagree with that. People want to own homes, but the biggest thing that they have to do is save money. And the easiest way to save money is if you can save money on rent. And so like just because rental rates are coming down, that's not a bad thing for the residential real estate market. It's actually good, because our renters can afford, hopefully, to save for down payment. Savings is the number one place where that down payment money comes from. Now, why are rents growing? I mean, slowing? Well, housing completions. And so when I say multi-apartment housing completions are up 60% year over year just in March. And so we've seen where housing, like the number of properties that we've been building, apartments, has just been skyrocketing. Yeah. So and so vacancies are up. When vacancies are up and building is up, prices are going to come down. And so that's why we're seeing prices stabilizing in the apartment sector, which will end up helping inflation overall, actually, because anytime that prices come down, that's good. But it hasn't impacted residential real estate, because we're still based on average demand.
Correct.
Now, this week we've got, on Tuesday, we have online productivity platforms for success, and that's going to be over in our Conyers office. And so Wordsworth will be teaching that day. And on Thursday, I'm teaching fast top dollar home sales with staging. That's going to be at our West Georgia Carrollton office. So if we can be of any kind of service, please call, text, smoke signals. We will do it all. And we hope you guys have a great week.
Thank you.
Thanks.
Happy Monday.